All right, everybody. Welcome back to the TSP Weekly Podcast, the one and only place you can get all the information you need about the TSP. Holy crap, man. Everything's going crazy. The market is changing on us again.
Yep. It was a heck of a week, and this is going to be a pretty important podcast, to be honest. So a couple nuggets in here that people really ought to pay attention to. We've been talking about it for months and months. It gets a little bit squirrely now that because we're not getting the data that we ordinarily get from because of the government shutdown. And so we're going to talk about unemployment. Unemployment, seemingly is the last shoe to drop, and perhaps it has, perhaps it hasn't, but we're going to talk through a pretty important report that certainly had an effect on the market this week. So, Weekly TSP Podcast, 9 November 2025. So we'll take a look at some of the weekly economic highlights. Unemployment, critical. It's definitely the most important part of the podcast. We did Hindenburg Omen last week. We're going to do it again this week because we had two more hits of the Hindenburg Omen this week. And when they happen in clusters, they are very significant. And we'll take a look at the equal weighted S&P versus the S&P 500 to kind of see. Equal weight means if all the companies on the S&P 500 were weighted equally, which they're not, right? NVIDIA is the highest market cap company on the S&P, and so it has the most weight. But if you weighted all 500 companies equally and did a chart of that and compared it to the chart of the S&P 500, you can see how important the tech sector has been since AI basically broke out in 2023. And then we'll take a look at just the TSP fund direction on a weekly chart and talk about that for a second. Okay, so this is a little bit different, right? Bond yields rose across the board at Treasury auctions. We've talked about this every podcast for the past couple of months, and literally every single week, bond yields have been lower across the board during Treasury auctions. This year they rose. 3 months, 6 months, 17 weeks, all of them sold for higher yields than the prior auctions. So investors are demanding a higher rate of return to buy U.S. Treasury bonds at different time horizons. That's not what you want, because the more you have to pay in yield is the more we're adding to the deficit. 30-year mortgage rose a little bit, a tenth to 6.31 from 6.30. But that had come down the prior week. The week before that, it was 6.37. So, this is in the midst of the Fed just is continuing its rate cutting cycle, right? We had the last rate cut on October 29th. So rates are not cooperating with the Fed. Fed's trying to cut rates. The longer term bond market is not playing along, and this is what it's kind of looked like. Okay, this is a chart of the 10-year yield. So the Fed controls the very short-term rate. It's the Fed funds rate is what the Fed controls. That's when they say they're increasing or decreasing the rate, it's the Fed funds rate, and that's the rate that banks charge each other to borrow money overnight. So that rate will trickle into longer-term bonds, but the longer it goes out, like this is a chart of the 10-year, the more that yield is controlled by the bond market, by the trading in the bond market. And so what I did was, this is, like I said, this is a chart of the 10-year yield. So we had bottomed out, right, after COVID. They dropped rates to like zero. The bond market went along with it. So the 10-year yield was really low down here. And then the 10-year yield started going up. And it was going up a lot before the Fed decided to raise rates, because basically it was looking at the bond market saying, okay, we're behind the curve and we need to start raising rates. And they were talking about we're raising it because inflation is going up. Well, the 10-year yield is already telling us that inflation is going up because they're demanding a higher yield. So now the Fed is in this rate hiking cycle, right? This is the whole rate hiking cycle in 2022 and 2023. Then we have a pause, right? And then the Fed begins a rate cutting cycle. Because why? The 10-year yield is already coming down. And now the Fed is trying to catch up. And so they start the rate cutting cycle, and rates and the 10-year yield goes up, right? They continue cutting, yield flattens out, and they've continued cutting here, and it's not pushing the rate down. Okay, maybe there's a lag. Maybe, eventually rates start to roll over, but the bond market is not responding to what the Fed's doing. If anything, the Fed's responding to what the bond market is telling it to do.
Yeah, it looks like it's the other way around, right? It looks like the bond market is driving the Fed, not the Fed driving the.
Right. That's what a lot of economists. That's what they say. It's not about what the Fed says. It's how the bond market responds, and that's the interesting thing, because everybody's always on the edge of their seat on every 2 months or whatever it is that the Fed does these meetings, and what really matters is how the bond market responds to what the Fed does. If they go along, then great. If they buck the Fed, something's not right.
So we're in the something's not right part right now.
Yeah. We're I mean, you could say 1, 2, 3, 4, 5. You could say 1, 2, 3, 4, 5. However you want to count this. This is a peak. And it's going to be really interesting to see if this is a one wave, this is some kind of a two, some kind of a corrective wave. I actually expected, again, this is 2020, right? And we had a peak in rates at 5% at the end of 2023. So that's a pretty long, a 2-year move up in rates. I was expecting some kind of correction to that, and for rates to get down here, back down here to 2% or something. And we talked for a while ago about that would be the best time in our lifetime to buy a house or refinance your debt or whatever, because after that, rates go up for a long time. The question is, corrections can happen either in price or time. So if we had it in price, it would be like that. If we have it in time, it's like this. Rates have corrected. They've gone sideways. So it's entirely possible that this is the 1, this is the 2, and they don't go much lower. They start a wave 3 up. And if the Fed cutting rates does not ultimately make this 10-year yield come down, then it's very stubborn. It's saying rates aren't coming down. Investors are going to demand a much higher rate of return to buy U.S. debt. I mean, that goes into a whole geopolitical conversation that we don't need to have right now, but it's really important. All right. Okay, unemployment. This is without a doubt the most important thing we're going to talk about, so kind of bear with me. The last data that we had, we talk about trading economics all the time. This is where all the data gets dumped into that website. August was the last unemployment data that we had. Okay, this is the unemployment rate as of August was 4.3%. And obviously, it was well above the 1-year average. Okay. This is a longer term chart of unemployment, and the green sections are recessions. So every time we get a bottom in the unemployment rate and it turns back up, it accelerates to the upside, and it gives us a recession. We hit a bottom, accelerates to the upside, gives us a recession. Every time. Okay, and we're going back to 1970. So every time unemployment bottoms and turns back up, it accelerates up, and we get a recession. The only outlier is right here, and we got a recession even though unemployment was going down. So unemployment itself isn't the thing that causes a recession. Well, you don't have to have rising unemployment during a recession, put it that way, right? This is an example of where we had a recession, but we did not have rising unemployment. But every time unemployment goes up, it accelerates to the upside, and we get a recession. So where are we right now? We've clearly bottomed in unemployment in 2023. It turned up, consolidated a little bit, and then broke above that consolidation period to 4.3%. That was in August. That's the last best data that we have. So we don't know what happened over the last 2 months. So we get this report. Well, okay. I'm going to get to this report, but this is an example of some of the layoffs, just a handful of the companies that have done layoffs in the last 60 days, except for UPS. That was the data for year to date. But all these were announced layoffs in the last 60 days. Okay. 9% of the salaried workforce of Molson Coors. 14,000 corporate jobs from Amazon. There's a lot of announcements a lot of layoff announcements happening. UPS was 48,000 jobs cut year to date. So then we get this headline from CNBC on November 6th. 10-year Treasury yield retreats after a big jump in October layoffs. Okay. So this is the report that they're talking about. It's from Challenger Gray and Christmas, is the company that put it together. U.S.-based employers announced 153,000 job cuts in October. That was up 175% from the cuts announced in October of 2024. So year over year, right, it was up 175%. And it was up 183% from the cuts announced 1 month prior. So September. It was up 183% versus the month before. So Challenger Gray and Christmas is a placement company. It's a very global placement company. So through October, employers have announced 1,099,500 job cuts through October of this year. That was an increase of 65% from the 10 months of the first 10 months of last year. It's up 44% from cuts announced in all of 2024. And year-to-date job cuts are the highest level since 2020, when 2.3 million cuts were announced through October. So in 2025 through October, we have 1.1 million job cuts. That's compared to 2020, which was COVID, when basically the whole economy shut down, and it was 2.3 million. So basically double, but it was COVID, right? This is a huge number through October of 2025. This is the highest total for October in over 20 years, and the highest total for a single month in the fourth quarter since 2008. Like in 2003, a disruptive technology is changing the landscape, right? That's AI. And I bolded this one. At a time when job creation is at its lowest point in years, the optics of announcing layoffs in the fourth quarter are particularly unfavorable. So the only thing that's been holding up the economy to this point, right? Everybody's probably heard the term the K-shaped recovery. The people that make a lot of money have been keeping the economy afloat. Okay, these are the people, say $200,000 to $600,000 a year level, right? These are a lot of the layoffs that are happening, and they're not finding new jobs easily. And so the negative wealth effect of that is absolutely going to be a piece of this, and you're going to see it in earnings and all the data that's kind of lagging. But the price will roll over first. The price of the companies will roll over first. Through October, U.S. employers have announced 488,000 planned hires. Okay, so how do we offset all these layoffs? Through October, 488,000 planned hires. That's down 35% from this point in 2024. It's the lowest year-to-date total since 2011. Okay, so the new hires aren't backfilling the layoffs. Included in Challenger's hiring figures, 372,000 seasonal hiring plan through October, the lowest number of announced seasonal hires through October since Challenger began tracking them in 2012. So we have an unusually high number of layoffs and an unusually low number of expected employment. Okay, that's definitely not good.
Yeah, well, let's talk about that for a second, because I find it fascinating because, I mean, it's not great if you're the ones getting laid off. Like, I get that, right? But what we saw was, the COVID did two things. One, yes, there were massive layoffs, but they weren't permanent.
Right.
A lot of those were kind of on paper, right? Because everything was shut down, so they had to do all these crazy things, and one of them was lay people off so don't have to pay them. But that completely rebounded when we're all back to work, and because of a lot of things, companies, massive companies like Amazon, brought on way more people than they really needed because online shopping went through the roof.
Yep. Because
everybody's sitting at home, even after kind of COVID. Like it's finally started to taper off. And then you match that up with, we've got this new tool called AI that is helping us be way more efficient. And this is what's interesting. I talked to a person that works at Amazon corporate, and they're like, we're not firing people that a robot has taken their job. It's not that. We're firing people because we had too many that we didn't need, and we don't need them because if you push forward, yes, AI will somehow make one person work 5 times more efficiently, right? That's what happened in the Industrial Revolution, right?
Yep.
Like once we started having that, it was like, and then we got the tech revolution, and now we're at the AI revolution. This has happened time and time again, right? It's not new. But then it's, what do those people do? Do they pivot, get a new skill set? Do they go start a company, their own business? Do they go from, I just saw a guy who gave up being a lawyer to go run hot dog stands, right? He's still employed, right? I mean, I don't think he's going to do it permanently unless he's really killing it. But my point here is, though, that, how do you pivot? How does that happen when you become unemployed? Do you stay unemployed? Because those unemployment numbers don't really work if a large percentage of those people pivot and open a small business. I don't know how likely that is for everybody, but we've got a lot of people with entrepreneurial spirit now, so maybe it is. So anyway, I feel like there is still a lot of missing data, and you're not going to get it for a while. But it kind of sucks that we don't have that missing data to be able to make these kind of larger economic decisions, right? Is it really falling apart, or is it just changing? That's different. Like you kind of pointed out before, there's a correction, and then there's like a down price move, like, time corrected or downward price movement. And so you look at a company like Amazon or Verizon. Verizon is getting ready to have massive layoffs. If you work at Verizon, I'm sorry for you, but I heard that yesterday. And it's because they're third in line now, and they want to catch up and beat AT&T and T-Mobile. So what do? They lean out, and they try to get more customers. And so what you'll see, though, is a more profitable company.
Yep.
So that's
the tricky part of this whole thing, because and it's sort of counterintuitive unless you understand what we're talking about. Layoffs on the front end are good for the stock price, right? Because if you have less overhead, you're putting out less. Your earnings per share go up. It's good for the stock price. In the big scheme of things, if too many people are unemployed, nobody can buy the product that the company is producing. It's a circle, right? It's a circle of life kind of thing. And whichever way in the short term, that's why, and all this stuff comes together. They talk about the potential of a blow off top. That's part of it. And you can get a blow off top because earnings go up, because there's less overhead the companies have to pay. But down the road, if that unemployment, like you say, if those people can't figure out how to matriculate into other parts of the economy, there's nobody to buy the product.
Yeah, exactly.
So we're in a transition, right? And it's tricky, and you're seeing it in the Hindenburg Omen, right?
Yeah, I think that's a good word, Jerry. I think a lot of people talk about crash. They use the word crash a lot right now, and I don't really think of it that way. I think of it as more of a transition and a correction. I don't know that it's a crash. I hope I'm right, because nobody wants to go through a crash. Nobody wants to go through a bubble. I don't think this is the same kind of bubble. An AI bubble is not the same as the tech bubble. We talked about that, I think, in the last podcast. It's just different, right? So I hope, even though hope's not a good strategy, I hope for a correction, transition, and not a crash. But yeah, let's get onto the Hindenburg. I think that's an interesting name. That's the guy's name, right? That's how I got named, right?
Hindenburg, the balloon.
Is it the same guy, or they just named it after the balloon?
They just named it after the incident.
Oh, that's not fun.
Yeah. Yeah. No, they named it after, a big important one-off. So if you didn't watch the podcast last weekend, basically the way you get a Hindenburg Omen trigger is the market has to be in an uptrend to begin with, which obviously it has been, since most recently since the low in April. Market breadth. A large number of stocks, typically over 2.2% of those traded on the New York Stock Exchange, must reach both new 52-week highs and 52-week lows on the same day. So of all the stocks traded on the New York Stock Exchange, which is basically all of them, 2.2% or more have to make new all-time highs on that day, and also 2.2% make 52-week lows on the same day. It's a little bit schizophrenic, right? It's basically saying that there's a lot of froth and on the upside and a lot of fear on the downside on the same day. You got to get negative momentum. So the McClellan oscillator is a sentiment indicator. It has to be negative on the same day that this thing happens. So momentum for the market is going down. At the same time, you have fear on the bottom for the bottom companies and exuberance for the higher companies. You got highs versus lows. The number of new 52-week highs cannot be more than twice the number of new 52-week lows. So the idea is that you have as close as not as close as possible, but basically you have a lot of new highs and a lot of new lows happening on the same day. That's the bottom line. And momentum is declining. It doesn't happen very often. And to really make it matter, the Hindenburg Omen, you want it to trigger multiple times over a short period of time. So they generally use 30 trading days. So we talked about it last week because the Hindenburg Omen had hit. This is what we were talking about last week. And it hit again this week. So now we have this cluster, right? And if we go back to, 2024, basically right here, we got a couple of individual Hindenburg Omen hits, right? And that's not that big a deal because the trigger really matters if you have clusters. So when you have clusters in a short period of time, that was the 2018 correction that we had. We had a bunch of them that began right before and went through COVID. And then we had a bunch of them right before the top in 2022. And we had, like I said, a handful of individual Hindenburg Omen hits. But now we have another big cluster right as we're at this top where we are right now. So it's a big warning flag, right? There's no way to know. We had a pretty big cluster here in 2018, and we had a pretty good correction, but it wasn't the end of the world. COVID, just call it a one-off. That 2022 are we launching into some kind of extended bear market, some kind of 10-month thing like we did in 2022? There's no way to know. It's a red flag, and so add it to everything else that is going on right now, and it all reflects each other, is what I'm saying. Okay, so if we looked at equal weighted S&P versus the S&P 500, so this is a chart of the equal weighted S&P 500, right? So imagine every company in the S&P is given equal weight. The blue line is the actual S&P 500, which it's called cap weighted. So the bigger the company, the more weight it has on the index. And so you can really see, here's 2023. This is when AI took off. and you can see the divergence, right? This is when big tech AI companies, Magnificent Seven, however you want to look at it, really started taking off versus the rest of the 493 remaining stocks in the S&P 500. Okay, and if we went back to, I don't know, May or June or whatever of 2020, like basically right before COVID started, the equal weight is only up 62% since then. The actual S&P is up 127%. So it doubled. The difference is 100% move, right? Which is telling you that the vast majority of this move came from those 7 stocks, basically, from AI companies. So what can we kind of take away from the chart? Going into 2022, obviously tech is always kind of overweighted in the S&P, right? Which is why generally you have this line below this line in general, okay? Going into 2022, we had the S&P actually rolling over before the equal weighted S&P rolled over, okay? Because tech wasn't the big leader, right? The tech rolled over and then the equal weight rolled over. Now, once we had the big divergence between big, AI, big tech, and the rest of the market, now when the rest of the market rolled over, right, we got a lower high here, but we had a higher high in the regular S&P. Once this rolled over, then AI rolled over with it. And that's kind of where we are right now. We're seeing a flattening, if not a rolling over, in the equal weight, but the cap weighted is still moving higher. So there's transition happening. We're seeing it in the underlying 493 stocks that have not performed obviously anywhere near as well as the equal weight, and they're starting to roll over. So if they roll over, and now we're talking about tech being in trouble, and certainly was in trouble this week. So if tech rolls over, that's where we are. Okay, so I'll take all that into consideration, and then you look at a weekly chart of the S&P 500 RC Fund. Okay, this is the 20-week moving average in blue, the relative strength indicator, and the MACD momentum indicator. So this is going to be a down week, right? We got a red candle this week. We had a reversal last week. But we are still well within that price channel. We haven't had any kind of a bobble since this April bottom. So we're in a trend. So the assumption has to be that the trend continues, because the trend continues until it doesn't. Could we get some kind of correction? Most of the time when the market corrects, it comes down and finds support at that 20-week moving average line until it doesn't, and then you have some kind of problem. But every time it comes down, the assumption is that it's going to get support there. And we're not anywhere close to it yet, right? So on a weekly basis, the trend continues. You have momentum falling off, right? Relative strength is basically flat up there at overbought, which is fine, right? You can stay overbought for a long time and price keeps moving higher. So there's no like reason to panic is what I'm saying on the chart. So you take all the things that we talked about and look at the chart and decide if you think the risk reward for remaining in the stock funds makes sense to you and your personal circumstances and risk tolerance.
All right. If you have any questions about anything we covered here in the podcast today, all you got to do is put it in the comments section wherever you found the video. and we will do our best to reply to anything in the comments section. If there isn't a comment section, you can always email us at support@growmytsp.com, and the support team will get it over to us. If it's anything personal related, we might not be able to answer, but if it's in general about the market or TSP related, we're happy to reach back out. If you guys like what you hear, share it with your friends. This is obviously a very difficult time for everybody working in the government and the military. Just a lot of angst, and then you throw in a little angst with the market. That doesn't make it any better. I know a lot of people right now that have told me that they're putting their head in the sand and just riding it out. And I keep trying to reinforce our message that you can't do that. Right? It doesn't help to just turn a blind eye to it and let it go. You need to stay engaged. Yes, sometimes it hurts a little bit, it stings a little bit. As Jerry pointed out in that last chart, we're still on an upward trend, right? Things feel a lot more scary on a day-to-day basis. And if it does feel that way, maybe you don't need to look at it every day. Maybe you should just look at it once a week, and you're going to be fine, right? Over the course of 20, 30 years, you're going to be fine. If you do it like we do for a living, sure, we look at it every day. But even then, you can't let it suck you into this sort of, constant anxiety over what NVIDIA's doing versus what Meta's doing, and then how the yield is, and all of that is just, you got to pull back a little bit. That's why that last chart we show every week here on this show really tells the story, right? Is it good to be able to drill down into it? Absolutely. And that's what we do for our members on our newsletter. We go a lot deeper, and we do give them a lot more information to kind of make their decisions. And if you like that kind of stuff, check our website out. All right. Hope you guys are having a great weekend, and hope you have a great week coming up. Anything else, Jerry? We're out of here.
No, I think we are good. It's going to be an exciting week for sure coming up.
It is. We'll see you guys.